Silver hit near record territory around $93, and then it didn't collapse. That's the part everyone keeps skipping past. After one of the sharpest vertical moves we've seen in years, silver didn't do what it's supposed to do. No violent profit-taking, no waterfall sell-off, no panic flush that resets sentiment and lets everyone feel smart again. It just stayed there, high, elevated, uncomfortable. And if you're watching silver right now, whether you're stacking physical, trading paper, or just trying to figure out whether you missed something, this should stop you mid-scroll, because failure to fall is information. Markets talk long before headlines do. And when a market rips higher and then refuses to give bears the pullback they're waiting for, that's not noise. That's structure, not hype, not narrative. Structure. Your job here isn't to call the top or bottom, it's to recognize what pressure looks like before it releases. That's what we're doing today, breaking down what's actually happening underneath the price, the stuff most people only understand after it's over. Before we go further, quick housekeeping. If learning how to read markets instead of predicting them sounds like your kind of edge, hit subscribe. This isn't a hype channel. We don't chase headlines. We build watch lists and learn how to read pressure before it shows up on CNBC. And drop a comment that says, "Watching silver." I want to know who's tracking this in real time with us. Now let's rewind. Silver pushed toward 93 and held, while copper cooled off, while broader commodity indexes pulled back, while risk appetite wobbled. Silver didn't retrace the way markets usually do after a move like that. That divergence matters. It tells you this isn't just macro momentum or algo spillover. It's silver-specific demand meeting, constrained supply and hesitant sellers. But here's the layer most people miss. Physical premiums didn't cool off. Short-term lease rates tightened instead of loosening. Exchange inventories didn't refill the way they usually do. And positioning data shows hesitation from sellers, not confidence. None of that shows up in a headline. None of it screams at you from a price chart. But together, they're pressure gauges. If this were a classic blow-off top, you'd already see ugliness. Heavy volume into resistance followed by rejection. Premiums collapsing. Inventory flooding back in as higher prices pull supply out of hiding. That's not what's happening. Something else is. And once you see it, you can't unsee it. Let me walk you through the first mechanism because this is where most people get lost. We call it the absorption test. Here's how it works. When price spikes and then pulls back slightly, but snaps back quickly without making lower lows, that's not random. That's buyers absorbing supply in real time. Think of a sponge. You pour water on it. At first it pools on the surface, but if the sponge is dry and ready, it soaks it up fast. The water doesn't run off, it gets pulled into the structure. That's what absorption looks like. Sellers show up, profit takers take profits, shorts test resistance, but instead of price bleeding lower, it stabilizes, bounces, holds near the highs. That tells you real demand is stepping in. Not retail FOMO, not headline chasers. Real demand. It could be industrial users locking in supply, it could be institutional positioning ahead of a shortage they see coming. It could be sovereign accumulation. We don't actually need to know who, we just need to recognize the behavior. Absorption always shows up before direction becomes obvious. This pattern appears before breakouts and before traps. If absorption holds, price moves higher when liquidity opens. If absorption fails, price flushes fast and violently. But here's the key point most traders miss. You can watch this happen in real time. You don't need insider info. You don't need a Bloomberg terminal. You watch how price reacts to selling pressure. Does it bleed lower or does it bounce? Does volume spike into weakness and price keep falling? Or does volume spike and price recover? Does the pullback make lower lows or does it hold higher lows? Silver right now is holding higher lows after a massive surge. That's textbook absorption behavior. And here's the uncomfortable truth. This is where impatient traders fund patient ones. The trader who sold at 90 because it has to pull back is now watching it grind at 92. The trader who shorted 91 thinking they nailed the top is now managing risk instead of adding size. Meanwhile, the buyers who absorbed that supply are sitting just fine. Not advice, just pattern recognition. I've seen this setup before. Gold in 2010, crude oil in 2021, copper more recently. Different asset. Same behavior. So burn this into your brain. When a market refuses to fall after a sharp move, respect it. It's either preparing to move further or it's setting a trap so clean it'll hurt. Either way, you want to be watching, not guessing. Now here's where it gets more interesting. Because absorption alone doesn't tell you when price moves, that's where the second mechanism comes in. Liquidity. Silver doesn't trend smoothly like equities. It stair steps, sharp move up, pause, grind, another sharp move. That's not random either. Silver trades in two worlds at the same time, paper and physical. Paper supply, futures, ETFs, options, can expand or contract instantly. When the liquidity valve is open, sellers can create supply out of thin air. Price feels heavy, controlled, orderly. Physical supply doesn't work like that. Mines produce at a fixed rate. Refiners process at capacity. Delivery takes time. Inventory moves slowly. When paper sellers hesitate and physical supply can't respond fast enough, the valve tightens. And when it tightens, price doesn't drift. It jumps. Think of a dam. When the gates are open, water flows smoothly, predictable, manageable. But when the gates close and pressure builds behind them, it doesn't leak out gently. It bursts. That's silver. And right now the signs say the valve is tightening. Short-term lease rates are rising. That's the cost to borrow silver for immediate delivery. Rising rates mean people who have silver don't want to lend it. COMEX registered inventory, the metal available for immediate delivery, isn't refilling the way it normally does after a price surge. Higher prices are supposed to pull supply out of storage. Instead, drawdowns persist. Physical premiums on coins and bars are staying elevated. In a normal cooling phase, premiums collapse as demand fades. That's not happening. Those are valve signals. They don't show up on a candlestick. They don't trend on social media. But they matter. Price is near record highs. Logic says supply should flood in. Sellers should get aggressive. The market should cool. Instead, supply is hesitant. Liquidity is tight. Pressure is building. Does that guarantee a breakout? No. Could this resolve with a sharp flush lower? Absolutely. But here's what you need to understand. Markets don't move when everyone expects them to. They move when liquidity opens or closes unexpectedly. If silver keeps refusing to give bears the pullback they're positioned for and the valve stays tight, the next move won't be slow. It'll be fast. And it'll punish hesitation. Not predicting, watching. So let's reframe the question. Because everyone keeps asking, should I buy or sell here? Wrong question. The real question is this: what happens if silver doesn't give the pullback? Because that's when markets get uncomfortable. Shorts stop adding conviction and start managing risk. Dip buyers wait and wait. Holders debate whether to lock in profits or let it run. And while everyone's stuck in that loop, liquidity keeps draining. Absorption keeps holding. The market dares someone to blink. I'm not telling you which path this takes. I'm showing you the setup so you can track it yourself. Because the traders who survive volatility aren't the ones with perfect timing. They're the ones who recognize pressure before it releases. So here are the paths. One possibility is continuation. Absorption holds. Liquidity stays tight. Sellers exhaust. Price breaks higher on thin liquidity. Shorts are forced to cover. Late buyers chase. Patient holders get rewarded. Impatient bears get squeezed. Another possibility is a false break. Liquidity opens briefly. Profit taking accelerates. Price flushes hard and fast. Late longs get trapped. Weak hands get shaken out. But the structure survives. The flush gets absorbed. It becomes a reset, not a reversal. Third path is the most silver-like of all. A range grind. Weeks of sideways chop. Attention bleeds out. Conviction stays. Then it moves when nobody's watching. No guarantees. Just paths with different signals. Your job isn't to predict which one wins. It's to know which one is unfolding. So here's what I'm actually watching this week. First, silver futures open interest. Rising with price means strong hands adding. Falling while price holds can signal squeeze risk. Shorts covering, not longs exiting. I'm not watching single-day spikes. I'm watching the 3-day trend. Second, physical premiums. In normal conditions, premiums collapse when price spikes. In stressed conditions, they hold or rise. If premiums stay firm at these prices, that's real demand. Third, COMEX registered inventory. After surges, inventories should refill. If they don't, supply isn't responding. Ignore small daily noise. Watch sustained direction. Fourth, the gold-silver ratio. If it falls and holds, silver is leading. If it snaps back higher, that's a warning. Use daily closes, not intraday drama. Fifth, volume near resistance. Heavy volume with rejection is supply overwhelming demand. Heavy volume without rejection is absorption. Wicks matter here. Now, risk matters too. If you're short-term trading, respect volatility. Silver can drop 8% in a day and still be structurally fine. If you're long-term, understand that sharp pullbacks don't kill a thesis. If you're new, don't chase. Build into weakness, not strength. My approach, again not advice, is watching these signals together. When several align, I lean into structure. When they diverge, I step back. You can't know timing, only pressure. So let's bring this home. Silver didn't crash after ripping to record territory. That alone is the signal. Absorption is holding. Liquidity is tightening. Physical supply isn't flooding back. Sellers are hesitant. These patterns repeat. Across cycles, across assets. Your edge isn't knowing what happens next. It's recognizing what's happening now. If you're watching these signals instead of waiting for headlines, you're ahead of the crowd that only moves after the move is over. You're not guessing. You're tracking. Markets don't reward certainty. They reward preparedness. So here's your assignment. Pick one signal, just one. Track it this week. Watch how it behaves, normal or stressed. Learn to feel the pressure. Drop a comment and tell me which one you're watching most closely. And if you've seen this absorption pattern before, in silver, in gold, in anything, share it. That's how we build this edge together. Subscribe if you want more of this. No hype, no predictions. Just real-time pattern breakdowns from someone in the trenches with you. One last thing. The traders who get hurt in moments like this aren't the ones who took a position. They're the ones who took a position without a plan for what comes next. Know what you're watching. Know what changes your mind. Know what keeps you in. That's how you stay in the game. See you in the next one.